Hello, everybody. Welcome to Collect Investments. Let's continue to talk about leveraged ETFs. Last time we talked about a simple formula. If the stock move up and move down, so then it stays flat, the leveraged ETF actually hurts because volatility is not good for leveraged ETF. But now let's look at the long-term return because we know in the long term, very likely the stock index will move up instead of stay flat. There is a formula from here. So this formula I copied from this paper called The Dynamics of Leveraged and Inverse Exchange Traded Funds. And this formula, we don't have to understand it. We only need to understand the basic trend of it. So in this formula, X means the leverage. For 2X ETF, X equals to 2. For 3X ETF, it equals to 3. And there's also a value sigma. Sigma square means the variance of the underlying. The bigger the sigma square, the bigger the volatility of the stock index. And then TN means time. So STN means the return in the future time, and S0 means the return at the beginning. So if TN is 10, then STN means the return in 10 years. So we can see the formula has two parts. The first part is a positive part because the regular return to the power of x, which is a final return, and if x is 2 or 3, that means the return will be amplified dramatically. But the second part is a number that's smaller than 1. It will reduce the return of the leveraged ETF. The bigger the leverage, the smaller this value, the second term of the value. And the longer the time is also not good. And also the bigger variance or volatility is also not good. Okay, so we already know that bigger leverage, like 3x, is worse than smaller leverage. And bigger volatility is not good. But here, there's a new factor, time. So we know that when we have stocks, we want to buy and hold for a long time. But here, the formula tells us if you hold it for a long time, the time is against you. So this makes leverage the ETF very dangerous. Okay, so what's the real number? If we plug in real numbers, what would the return look like? If you click this tiny URL, you can find a Google Sheet. Okay, so this is a Google Sheet. You can make a clone. You can make a copy of the Google Sheet. Then you can modify it. For me, I can directly modify. So, okay, let's see how we read this. On column A, there's years. So in how many years, what's the overall return of the stock? And the underlying index, I assume every 10 years it doubles. So, and 10 years, you double from 1 to 2, 20 years to 4, 30 years to 8, 40 years to 16, and so on. For 2x ETF, I calculate using the above formula that we mentioned before. And for 3x ETF, it's the same. So here, the annual return, 7.17, makes it double every 10 years. But the volatility is a key factor here. The higher the volatility, the worse the return. So let's say use a smaller volatility, for example, 21. Okay, so with 21%, you can see that for 2x ETF, after 80 years, the return is 1900, much bigger than the underlying. It's also bigger than 3x ETF. If you make it even smaller volatility, 20%, see, the 3x ETF is getting better. What about 19? 3x ETF is even better, closer to 2x. And what about 18? Okay. For 18% volatility, 3x is finally better than 2x ETF. And what about 26% higher volatility? Now, 3x ETF, almost no change after so many years. Much, much worse. And 2x ETF, slightly better than the underlying. If we continue to increase the volatility, 2x ETF is even worse than the regular index. So the volatility is a key factor. We know that 26% makes the 2x ETF better than underlying, and 19% or 18%, yeah, 18% makes 3x better than 2x. So what are the real volatilities compared to 18% and 26%? So let's go to Yahoo Finance and open the volatility index of S&P 500, which is actually called VIX. So this is the VIX value. And you can see that the volatility value recently, the last year, is very low. It's 13, very good. But in the year of 2022, the stock drops quite a bit. There's a small bear market. Volatility goes up to more than 26 many times. So in general, in a bull market, when market goes up, volatility is low. But when market goes down, volatility is high. So if you look at more years, you can see there's long periods of time that volatility is very high. So all this means that the 3x ETF is very dangerous because of this form, the volatility. And we should avoid it at all cost. 2x ETF, if it's in a bull market, it's good, but in a bear market, it's not good. But who can predict whether it's in a bull market or bear market? It's market timing. We cannot do that. So that's why I do not recommend people buy and hold leveraged ETFs. So 3x not worth to do, only better than 2x if volatility is very, very low. So it's too dangerous to hold. 2x is good if volatility is less than 26%. And by the way, this is a theoretical calculation. So it does not take into any of the friction. For example, the interest, the management fee, the tax, all of those are not considered. If you consider those, the real return of leveraged ETFs are very likely lower than this formula. So overall, based on this formula, I think leveraged ETFs is not a good property to hold for a long time, and I do not recommend to buy and trade it. Okay, that's all for today. Thank you.